Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Profitability ratios. Profitability ratios are a powerful tool to measure and evaluate the ability of a company to generate income from its operations, assets, and equity. They help investors and analysts compare different companies in the same industry and assess their financial performance and efficiency. Profitability ratios can also reveal the strengths and weaknesses of a company's business model and strategy. There are two main types of profitability ratios: margin ratios and return ratios. Margin ratios show how much profit a company makes from each dollar of revenue it earns. They indicate how well a company controls its costs and expenses and how efficiently it uses its resources. Return ratios show how much profit a company makes from each dollar of investment it receives. They indicate how well a company creates value for its shareholders and how effectively it employs its capital. Some of the most common profitability ratios are: gross profit margin. This ratio measures the percentage of revenue that is left after deducting the cost of goods sold (COGS). It shows how well a company manages its production costs and pricing strategy. A higher gross profit margin means a higher profitability from sales. The formula for gross profit margin is: gross profit margin equals revenue COGS/revenue. Operating profit margin. This ratio measures the percentage of revenue that is left after deducting all operating expenses, such as wages, rent, utilities, depreciation, and amortization. It shows how well a company manages its operating costs and overheads. A higher operating profit margin means a higher profitability from operations. The formula for operating profit margin is: operating profit margin equals revenue operating expenses/revenue. Net profit margin. This ratio measures the percentage of revenue that is left after deducting all expenses, including taxes and interest. It shows how well a company manages its overall costs and income. A higher net profit margin means a higher profitability from all activities. The formula for net profit margin is: net profit margin equals revenue expenses/revenue. Return on assets, ROA. This ratio measures the percentage of profit that a company generates from its total assets. It shows how well a company utilizes its assets to produce income. A higher ROA means a higher profitability from assets. The formula for ROA is: ROA equals net income/total assets. Return on equity, ROE. This ratio measures the percentage of profit that a company generates from its shareholders' equity. It shows how well a company creates value for its shareholders. A higher ROE means a higher profitability from equity. The formula for ROE is: ROE equals net income/shareholders' equity. Profitability ratios are useful for comparing different companies in the same industry or sector, as well as for tracking a company's performance over time. However, profitability ratios should not be used in isolation, as they may not reflect the full picture of a company's financial health and sustainability. Other factors, such as liquidity, solvency, growth, and risk, should also be considered when evaluating a company's profitability.